A steel mill goes quiet. The furnaces cool. On the notice board, there is a list of names. Every one of them has been laid off. A farmer watches his tractors get sold at auction. Not because he was lazy, not because he was reckless, but because his biggest customer, China, stopped buying. In 2018, the United States launched the largest trade war in modern history. It was sold as a revolution, a promise to bring back our factories. It was a war that would be, in the words of the president, easy to win. Instead, it wiped out an estimated $2 trillion in US market value. It raised taxes on American businesses and consumers, and it helped push American manufacturing closer to the edge. So how did a policy meant to save American industry end up hitting American manufacturers hard? For most of the 20th century, Made in USA meant something. American factories were the engine of the world. By 1960, 1 in 3 American workers had a job in manufacturing. Then the world changed. Shipping got cheaper. Trade agreements opened markets. And in 2001, China joined the World Trade Organization. Offshoring was no longer a fear. It was a business plan. Between 2000 and 2010, the United States lost about 5 million manufacturing jobs. Entire towns watched their factories leave. The jobs did not vanish. They moved to Mexico, China, and Vietnam. By 2016, anger over trade was not abstract. It was personal. Donald Trump tapped into that fury. He called NAFTA the worst trade deal ever. He blamed China for stealing American jobs. And he made a simple, powerful promise. We're going to bring back our jobs, believe me. His main weapon would be tariffs, taxes on imported goods. He said other countries would pay. He said America would win. To understand what happened next, we need to understand what a tariff really is. Imagine you own a hardware store. You buy nails from a supplier in China. They cost you 10 cents a pound. You sell them for 12. Now the government steps in and says, we are putting a 25% tariff on those nails. The Chinese supplier does not cut the price, so your cost jumps from 10 cents to 12.5 cents per pound. What do? You either raise prices on your customers, or you absorb the cost and watch your profits shrink. Multiple studies, from Princeton, Columbia, and the New York Fed, examined the 2018 tariffs. They all found essentially the same thing. Foreign exporters did not meaningfully cut their prices. American importers paid the tariffs, and those importers passed the costs onto American businesses and consumers. In other words, these tariffs were a domestic tax increase, one of the largest new tax increases in decades. Here is the twist. American manufacturing runs on global supply chains. Your American-made car might use steel from Brazil, electronics from China, and seats from Mexico. Tariffs did not just hit finished products such as washing machines. They hit the raw materials and parts that American factories rely on. It is like taxing the flour and the eggs, and then wondering why the bakery has to charge more for bread. Now watch what happened when those tariffs spread across the economy. Trump's trade war came in waves. First came tariffs on solar panels and washing machines. Then came 25% tariffs on imported steel and 10% on aluminum, hitting allies and rivals alike, Canada, the European Union, and Mexico. Allies called it illegal and responded with tariffs of their own on American whiskey, motorcycles, and farm products. Then came the main event. China. By late 2019, the United States had imposed tariffs on about $370 billion worth of Chinese goods. China hit back with tariffs on about $110 billion worth of US exports, on soybeans, cars, and industrial machinery. For American farmers, the impact was immediate. China had been buying more than half of all US soybean exports. Within months, that demand collapsed. For manufacturers, the pain was slower and deeper. Steel became more expensive. Electronics became more expensive. Planning became harder. By mid-2019, manufacturing surveys were flashing red. Factory output slowed, investment stalled, new orders fell, On Wall Street, markets whipsawed with each new tariff threat. Analysts at Bloomberg estimated that by mid-2019, Trump's trade war had helped erase about $5 trillion in global stock market value. Roughly $2 trillion of that was in US markets alone. The easy-to-win war was starting to look very expensive, but some of the biggest losers were not visible on Wall Street. They were on factory floors across America, the very people the war was supposed to protect. To see how, we need to look inside these plants and follow the money. One of the clearest case studies is washing machines. In early 2018, the United States imposed tariffs on imported washers. Economists tracked what happened before and after. Within months, the price of washing machines in the US rose by around 12%. Dryers, which were not even subject to tariffs, also went up in price. Manufacturers took the opportunity to raise prices across the board. The result was that American consumers paid roughly $1.5 billion more. Those higher costs created about 1,800 new US manufacturing jobs in that industry. That works out to roughly $800,000 in extra costs per job. And that was just washers and dryers. Across the economy, tariffs quietly raised prices. Studies estimated that by late 2018 and 2019, tariffs were costing US consumers and businesses tens of billions of dollars per year. Those costs were not paid by China. They were paid here, at home. But the biggest paradox was still to come. The war that was supposed to save factories was hurting factories. To see how, consider a Midwestern manufacturer. Imagine a small manufacturer in Ohio that makes steel components. Before tariffs, it bought imported steel at competitive prices. After tariffs, its steel costs rose by 20 to 30%. Its foreign competitors in Europe or Asia did not face the same spike. They could still buy cheaper steel. Suddenly, an America First policy left American firms last in line on price. Across the country, manufacturers reported the same pattern. Input costs soared. Customers resisted higher prices. Profit margins shrank. From 2010 to 2016, US manufacturing slowly added back jobs after the Great Recession. From early 2017 through mid-2018, the recovery continued. But as tariffs took hold and uncertainty rose, job growth flattened. By late 2019, manufacturing employment was declining again. Not every factory lost. Some steel and aluminum producers, sheltered by tariffs, did hire. A few mills restarted blast furnaces. However, the net effect across all manufacturing was negative. Research by the New York Fed and others found that job losses in downstream industries, companies that use steel and aluminum, outweighed job gains in the protected sectors. For every job saved at a steel mill, there were many more jobs at companies that use steel, auto plants, machine manufacturers, construction equipment makers. Making their key inputs more expensive rippled through the entire chain.